And so at the bottom of that sell-off in April, I raised the target to 8,700. And then in October, after we had the big rebound, I looked again and I said, that's not enough. So I raised targets again to 9,500. So my S&P target right now is 9,500.
That is a huge move. And you think that could happen in this calendar year?
In fact, I think it could happen in the first half of this calendar year. In my opinion, this is, the end of the super cycle that I define as the long cycle between two depressions, the 1930s and what I think will be the mid-2030s, so a 100-year cycle. And it basically is the end of a Ponzi scheme. We've ramped it up every cycle more. It's just, it's a sine wave type thing where it just gets bigger and bigger each time. The excesses get greater. The response to bring the excesses down get greater. And you get to a point where it just gets out of control, and our politicians will have zero control over this.
Let's articulate the moment the Fed loses control of the printing press, because that's a huge fundamental component to your thesis playing out. When will that happen? How will that happen? Before we get started, this podcast is not investment advice, and I'm certainly not a financial advisor. Before investing, do your own research, speak to a licensed advisor, and remember, risk is part of the game. It's my pleasure to welcome back David Hunter to the show. For any viewers who don't know, David is a seasoned Wall Street strategist with over 50 years of experience navigating bull and bear markets, but he's best known for his bold macro forecasts and contrarian calls, understanding the psychology and sentiment behind some of these moves in the market. And while the market has climbed a wall of worry for years, David has probably been the most outspoken bull. So we spoke at the end of April last year, and you laid out a very specific roadmap, a final melt-up in equities and precious metals, followed by a major deflationary bust, and then a policy response so large it would change the world forever. Let's start with the melt-up. Where are we at today?
Yeah, I think we're probably going to see a little bit more correction here. It's been kind of since late October and sideways consolidation at the high end of the market. But I think we've probably got a little bit more to go. I don't know whether something happening in Iran will be the catalyst, but it seems to kind of push up against the highs and then back off. So I think it's waiting for some resolution there at least. But I'm not looking for. There are people out there calling for big corrections, 10, 20% or more. And I'm not looking for that. I think, the S&P could get back down to 6,700, maybe a little below that if it wanted to, which would be 4 or 5% off the highs.
Right.
And obviously NASDAQ and Russell could do a little more than that. But after that's out of the way, I think it is off to the races. We go through what I think is going to be the final melt up, final parabolic piece of what I call 43-year secular bull market.
Yeah, the S&P seems to be kind of bouncing up against that 7,000 level, the last few months and just can't quite get there. So you think a little bit of a reset, downtrend. Is your target still 8,000 in this calendar year for the S&P?
Yeah, it's interesting. That's why I'm thinking we haven't talked since April. I've raised my targets at least 2 or 3 times since then. So 8,000 was my target. And that I put in there, I think, early last year. And then with the tariff announcements in April, and we got that swoon, while everybody else was cutting targets and getting a lot more bearish, as a contrarian, I saw sentiment really turn south. And so at the bottom of that sell-off in April, I raised the target to 8,700. And then in October, after we had the big rebound, I looked again and I said, that's not enough. So I raised targets again to 9,500. So my S&P target right now is 9,500.
That is a huge move. And you think that could happen in this calendar year?
In fact, I think it could happen in the first half of this calendar year. Doesn't have to. It may stretch out. Everything I do seems to, I anticipate that it takes a little longer, but yeah. I would not be surprised if this goes parabolic that we get there by this summer.
That's incredible. What about the metals? Do the metals go for the ride? I mean, they've been the outlier. They've been incredibly resilient. Talk to me about gold and silver and how you see them performing.
Yeah, I've raised there too a few times, so it's hard for me to keep track of when I did what. But I am now, and I came into this year. I raised, I think last October. I usually raise my in my quarterly letters.
Okay.
So I raised silver. Well, I'll start with gold. Gold, I think I raised from 4,000 to 5,000 last. I don't remember whether that was last October or whether I.
You've been bang on when it comes to gold. Yeah.
Yeah. So I raised it again just recently. Well, yeah, that's right. I raised it to 5,000 from 4,000 last October. Then I raised again in my first quarter letter in January to 5,500. And I just raised on this last sell-off. Again, I tend to do it not with momentum, but the opposite. In this last sell-off, I raised it again to 6,800. So I'm now at 6,800 on gold. Silver, I'm now at 180. And, went through a few. I was at 75 for the longest time for several years.
Yeah.
Raised it to 100. Probably in October, raised it to 125, I think, in January. And then, a month later, I'm raising it to 180. So
Yeah.
I am clearly bullish on the metals. I think, and I actually, the week before the sell-off, or, when we had that spike to 122 on silver, I said we could see a very quick 30% sell-off. This isn't the peak. It will rebound from that. Well, we got more than 30%. And I do think this thing is, also, those targets could be seen by this summer.
I'll never forget that 75 silver call that you had in early April when you came on. Silver was trading at $32, $33, and even I was giving you a bit of strange looks there when you said it's going to 75. I mean, it didn't even pause to say hello to 75. It just
and that 75 was my target 3 years ago. When people thought I was crazy. I mean, yeah, you're not going anywhere near that. So it took a while to get going. Gold got going sooner than silver, but once they got cooking, it really ran.
What really got me on the David Hunter bandwagon, as it were, was your S&P call, right? I think the first time we came on, a year and a half, 2 years ago, SP was 3,500. You said it's going to 6,000. It's going to 6,000, and it was at 3,500. And it just, the way it moved there so quickly. So what is it about your ability to make some of these forecasts when the market is experiencing weakness, when people are starting to get pessimistic, you're all of a sudden getting bullish? And then, what do you see in the sentiment? How do you know it's going to switch back?
Yeah, a lot of it is sentiment driven. I've been doing macro for 50 plus years. So I feel like my macro capabilities are really strong. And I have a lot of, they allow me, because I have been through so many cycles and have been, I've gotten to feel very comfortable with my abilities there. It allows me to have conviction when most people do not. So, so a lot, sometimes people misread that as cockiness or, being too sure of myself. And it's not that at all. It's conviction based on years and years of doing this. And in terms of sentiment, some of it's probably God-given, but certainly over 50 years I've developed. I've been, for many cycles, very comfortable being basically alone against the crowd. When the crowd is, I'm at my convictions are at their highest when the crowd is all in agreement, and I'm way over on the other side of the room. I'm going, nope. So, it's a funny thing. Like I said, some of it I think is developed and some of it is just God-given. I just don't need to be with the crowd. The crowd doesn't influence my thinking. And obviously from a market standpoint, it's been proven over and over that when everybody's in agreement, you don't want to be there. So it's funny because I'm getting challenged on X now because obviously my silver and gold call is not, momentum is what drives most people. So silver and gold call is not contrary at all. And I'm starting to get plenty of company on the bullish side of the stock market. And so people go, you're not a contrarian. I go, well, you misunderstand what a contrarian is. For me, anyway, I'm most contrary at inflection point. So when everybody's all in, I'll be bearish. When everybody's all out, like they were in October of 2022, I'll be very bullish. So it's in between. There's actually a period in there where the consensus is very right, and right now
Right.
that's the case.
And that's the case for gold, like gold, because I mean, Goldman Sachs has a 6,800, target this year. HSBC is now at 7,000. Bank of America is up at 7,000. There's a lot of different people here. Jeffrey Gunlock is at 7,500. So a lot of different people are calling now for gold to have this huge run, in 2026. Does that concern you at all?
Not yet. I mean, it will. I'm surprised because I haven't really followed where everybody's raised their targets to, but
Hmm.
I didn't realize so many were above my target. But no, I'm not concerned at all yet. I think that time is coming.
Yeah.
And the other thing with unlike the stock market, which I think is putting in a generational top, meaning it could that the highs of this market, once we get there, I think will stand for decades. Not one decade, maybe two, maybe more. Whereas the metals, post bust, I have much higher targets. So the only reason I'm probably more conservative than some of those people now is my concern that we're heading for a global bust. If I were straight lining this thing, I'm looking for 20,000 gold in early next decade. I'm looking for. I had been saying 500 silver and thinking that's a reach. I'm now thinking, if we get to anywhere near 200 this cycle, and there are people even saying it'll go higher than that this cycle, 500 seems way conservative. So, but anyway, my
Yeah.
early 2030s call is much higher than these numbers, but I see a bust in between. So,
Yeah. Let's get into that, and some of those gold forecasts may be, they're from the bank, but it may be just, one commodity analyst. It may not be, it's not maybe their base case. It's maybe, one or two guys. But nevertheless, yeah, let's talk about the bust. Obviously, we're moving towards this parabolic move that you see coming with the markets. The bust is going to look like what, and how long will it take to recover?
yeah, I define a bust as something that's deeper and bigger than a recession, not as drawn out as a depression, like the Great Depression. And it's accompanied by what really makes it a bust is it's accompanied by a financial crisis of major proportion. So 2008-9 was very close to a bust. As I say, I think they brought it back from the cliff just in time. Back when GE was, the course paper market was freezing up in late 2008, and they were talking about, GE might fail because they have to access paper, so have to access those markets so often. The government acted fast enough, the Fed acted fast enough, and they pulled us back from the cliff. Because of 2008-9, there's going to be reluctance this time around to act. They're going to say, "Oh, we don't want to go back there again." You've heard all the criticism about QE and QE to infinity, et cetera. And Powell's been on record many times as saying we're not going to repeat that mistake. I think pretty much Wall Street says that was a mistake. So when the time is similar, they're going to be reluctant, or they're going to be doing it in baby steps and taking longer to get there. So as a result, I think we can go over the cliff this time, and all that means is I think we could see more bank failures and more financial dislocation than we saw then, as bad as that was. They will inevitably have to react. It's just a question of timing. If they react soon enough, they can avoid a bust. If they don't act soon enough, they go over the cliff and then have to pull it back.
How does this coming appointment of Kevin Warsh change anything? Does it change anything for you? Do you think he will wait longer than a Jerome Powell, for example?
Yeah, it's interesting. I thought Kevin Warsh was the best pick. I wanted him. He kind of flies in the face of what I'm talking about in terms of what they should do, right? Because he's one that says we got to reduce the balance sheet, and and he's right. I mean, when we look at the craziness of what happened post or during the pandemic and post pandemic, you got up to 9 trillion on the balance sheet. I remind people that in October of 2008, before the crisis, or at the verge of the crisis, the balance sheet was 875 billion, and that was as high as it had been in the life of the Fed from 1913 on. So we went from 875 to 9 trillion over the course of the next less than 20 years. Um, and so anybody would say, yeah, that makes no sense. And I'm a monetarist. I'm not preaching for more money. Um, However, it's kind of where are we in the big picture? And in the big picture, there's going to be the only thing that's going to save us is money, because when things start falling apart, it's not fiscal that saves you, because that can't move fast enough. It's the only thing that can really save you is pumping liquidity into the system, and this is going to be global. So I focus on the Fed, but it's really every central bank. So Morse being who he is, and all his statements, yeah, he's somebody that's probably going to be slower to react, if anything. I basically would say that almost, whether it was Powell, whether it was Warsh, whether it was one of the others, it's almost, this is bigger than any of them. It's really, they don't want to fight they're fighting the last war, which was 2008-9, and so they're going to be slow to make that same mistake, and yet that's what they're going to have to do. So it really isn't Warsh versus the others, but if anything, he's going to be slower because he's kind of feels like that's the wrong thing to do anyway. But in terms of, it's interesting because you heard all the narrative after he was appointed that Trump is getting somebody that's going to do what Powell did, and he's not going to be happy. And why did he? Warsh must have fooled him, or what? If you listen to Warsh's interviews after he was appointed, he does have some of what Trump has been saying, which is, we're doing this Phillips curve thing. If the economy's strong, we got to hike rates, or we can't cut rates. And if you have productivity gains, or if you are in an environment where, because of other past policies, inflation's coming down, you can have growth without it causing inflation. So, really, I can't fault Powell. I've defended him many times against all the criticism. If you look, he brought inflation down from 9%, and we didn't crack up the economy. So, how can you say he did it wrong? However, looking forward, I think they are way too restrictive right now. The economy's going to start unraveling, and they're going to, as the Fed always does, have to catch up. So, but up till now, I haven't agreed with Trump in terms of the criticism. And frankly, I've always said the bond market determines rates, not the Fed. So, why don't you got a lot of other things on your plate, focus there, because really it's not Powell that's the problem.
Yeah.
But from a bigger picture standpoint, I do think rates are restrictive and are too high. And so, he's right about that. And Warsh basically agrees with that. So I think that Wall Street and the media got it all wrong. I think, in their typical anti-Trump
slant,
bias, they can't help themselves but have to be faulting whatever he does. So.
Time will tell. I'm sure they've had a lot of closed door meetings, and I'm sure they're on the same page. But when he was appointed, it did make me think of, your thesis in that, he does have this hawkish era to him, that he will wait longer. And that's exactly what you forecast. Let's talk about bonds and interest rates. Bonds is one area, you'd spoken previously, like you thought, by now we'd maybe be at 2.5 or sub 3. We're still above 4 on the 10-year. When do you see that cracking? Like, you just spoke to it a little bit, but can you just elaborate?
Sure. I mean, obviously this whole cycle has played out longer than I thought. And so people say your timing's way off. And that's, I just keep stepping back and saying, I'm forecasting a cycle. This is not a trading call. It's not meant to be. I give you ideas of what I think the timing is going to be, but it's really, my forecast is really, the cycle will be whatever it is. And so the fact that the cycle is extended means the interest rates have been held up longer. But I do think, the back up to 430 And then the reversal since then, I think, is the beginning of the rollover. Once we get through 4%, you'll know you've pretty much completed the. It's basically a 2+ year top that rates have been building here. Got up to 10-year got up to 5% back in late 23, I think, and it's been ever since then in this trading range between basically high threes or 4% and mid fours or somewhere in there. So I think we're about to exit that. About means could be a matter of weeks or even days, but probably weeks. And that once we get going, I see us moving down sub 3% during between now and summer. And then if we truly are going to see a global bust sometime later this year, then you'll move from 3% down to zero pretty quickly, I think, meaning over 6 or 9 months. Because
in a world of rising deficits, currency dilution, and market volatility, many U.S. investors are choosing to diversify their retirement accounts with assets like physical gold, silver, and even crypto. This video is sponsored by iTrustCapital, which offers a platform for Americans to hold physical gold and silver, as well as crypto, directly inside a tax-advantaged IRA. Designed around transparent pricing with clear premiums over spot and no hidden storage fees, iTrustCapital offers something that still isn't standard in the precious metals IRA space. If you're a U.S. investor looking to learn more about owning gold, silver, or crypto inside an IRA, use the link in this video description. U.S. residents may be eligible for $100 funding bonus when opening and funding an account with iTrustCapital. Now, let's get back to the pod.
Because once you get into that bust, again, people have to understand you'll have the beginnings of a recession before you have a bust. You're going to see the economy slowing and then going into recession, and the bust comes after that as accidents happen, as things start happening financially. But once you get into the bust component, you're not only going to have people running to the Treasuries for safety, for it's one of the few things that's not going to be going down. You're also going to have the Fed, as reluctant as they are, having to pump QE, and they'll start out with, we're reluctant to do this, but we're going to do $1 trillion because we have to, get liquidity into the system, and ultimately, I think we're going to get to 20 trillion. So, for how long is it going to take them to get from $1 trillion to 20? Probably 6 or 8 months or more. But that last chunk.
That's new. Just to clarify, David, that's new QE. That's new liquidity. It's not going to take the balance sheet from 6.5 or wherever it is to 20.
I think it'll be 30 trillion. 30 trillion. And again, that's totally my guess of what it's going to take to turn the thing around. And we don't even know that we're going to have a bust. I mean, I've called it bust for so long. I mean, people think I called it for the next 6 months or so. I said, my timing on the bust has always been, we have to complete the bull market in the stock market before you'll see a bust. So, and I've never been bearish on the stock market. So I said it's always pushed out because the market's pushed out. But if it does happen later this year, I think they'll start gradually. But ultimately, once you start seeing free falling financial failures across the globe, it's going to be every central bank is going to be saying whatever it takes. They'll start out with pieces. So and then find out that's not nearly enough. It's not stopping anything. They'll go to a bigger chunk thinking that's more than we ever thought we'd have to do, not stopping. And then finally, it's just whatever it takes.
Yeah. They just throw in the towel and say, it was interesting. In Japan, they just had another election, and the prime minister there got even more control. And she is, very friendly with Trump, but she's also got on the record that they're going to print if they need to. So, Japan will be right there if the crisis hits, obviously, as well, printing. Obviously, this is going to create a tsunami of inflation post-bust. What does that look like? I mean, you've spoken during the bust, the only place to hide is the dollar and Treasuries. Is that still correct?
Yes. Okay. And the dollar, it will be people have to understand, because I'm still looking for an $82, DXY down to 82 here between now and, sometime in the bust, because I think it'll still go down early in the bust or early in the recession anyway. And then from there, once the bust really becomes apparent, is really causing concern around the world, I think the dollar gets that flight to safety trade it always gets, and it'll get bid up to maybe 120 or higher. And from there, it goes down. So during that period, as long as you don't think it's straight from here, that the dollar will be one of the things that I think holds up during the bust.
We're 96. I think we just crept above 97 this morning on the DXY. That's not too far to go to 82. Do you keep some exposure there because you don't obviously know exactly when the bust is going to begin, or are you, until you see it kind of get a lot lower, you're not interested?
Yeah, I don't give financial advice, and I don't talk about what I do because it'd be taken as financial advice. So,
right.
But what I will say is, you're probably the first one that I've ever heard tell me that 82 is not very far away. 82 is a big drop. To go from, we were at 115, we got down to the mid 90s and then rallied back over 100. So this move is really from 100 down. If you go down to 82, that's a very big move. But I think we probably run down to the 90 or thereabouts. There's a lot of support down there and bounce from there and then go down to 82. So it's going to take time. It's not going to fall that quickly. But I would say, I'm still out there with that 82. I don't think there's anybody even close to that forecast. So I think for most people, they think 90 is possible, but not 82.
I got into the business in the mid 2000s. So I remember, the dollar crashing down into the low 70s in 2010, 2011, right, when gold had its previous peak. So I know it can go there. And if you look at 96 high, 97 to 82, that's less than 115 to where we are now, right?
Right, exactly.
So, and some people are calling for a lot lower on the DXY.
Well, I do think, there are probably the Austrians, the Austrians who think this is the big one, that we crash here.
Right.
They probably have that view. I do think the dollar could be under 50 early in the 2030s. As I say, the difference between myself and a Peter Schiff or any of the Austrian crowd is that the Fed, because I'm calling for a deflationary bust, in deflation, you have a printing press, and they will do whatever they have to do. They may not talk that way now, they may not at all, and they don't at all realize that it's coming. But once they're in the midst of it, that printing press will kick the can down the road one more time. It's going to be a big. It's like there's going to be a bust that isn't going to be comfortable while we're in it. But because they have a printing press, they'll pull us out of that, and we'll have one more cycle. So the difference between myself and the Austrians is that I think we see a collapse of the system in the mid-30s. They think the collapse of the system or the reset is now.
It's happening now.
So I can see why they think the dollar would go a lot lower now, because of, I believe we could save it one more time because of the printing press. My case is that the dollar probably starts heading south after the bust, and could get down to 50 early in the 2030s. So I agree. Ultimately, it's going down, but not in one straight line.
And the DXY, in some ways, is almost a little bit meaningless because it's measured against a basket of other fiat currencies, which we've spoken about before, right? Talk about the equity market. So the bust could last between, I think you've said, six months and 18 months, somewhere in there.
I think the bust itself, which is the economic part of the forecast, like I said, it's a very bad down economy accompanied by a financial crisis. That's the bust. I'd say 12 to 18 months. That doesn't mean you don't have lingering effects, because I think there's a lot that coming out the other side that will still be, the consumer is going to get hammered. So I think the next cycle looks very different. But 12 to 18 months, I think the stock market, the bear market might last 9 months or 12 months, depending on how long the bust is. But, you'll have in a bear market, it's not going to be straight from the top to the bottom. You'll have bear market rallies. part of that probably driven by the Fed stepping in and saying, we're going to print several $trillion here. And everybody gets excited thinking that marks the bottom. So you might be down 50% at that time and then rally back halfway. And then they realize that's not nearly enough and it goes back down, or more problems show up and it goes back down. And you're down, 75, 80%. And then, so you'll have at least two legs down, maybe even three. So that plays out over time because, those bear market rallies might last 2 months each. So if you had two of them, it stretches it out 4 or 5 months, and then the downs are 2 or 3 months. So,
and then when it begins, when the balance sheet reaches 30 trillion, or the Fed has deployed enough liquidity to save the system, and everything starts ripping again, inflation is going. What are some of your inflation targets? And
so
what does it look like?
I think coming out of the bust, because if I'm right, I think you're going to have deflation. I mean, we're at essentially, depending on which index you listen to, if you listen to Trueflation, we're at 1% inflation or whatever. So, but let's say we're 2.5%, and we're in recovery, or we're still in a positive economy. If you go into a negative economy, you're going to be below zero, and I think pretty definitely, and maybe 3 or 4% below zero. So if you're coming out of a deflationary environment, that first year out, you're probably at very low single digits. Second year out, you may be moving into high single digits. Third year out, you may be into double digits, and then you really start roaring from there. So, by the end of the decade, or early next decade, you could be at, 12, 13, 14% on the way to 25%. I think in 1981 or two, and I was, an institutional investor then, we had 20% inflation. So this time around, I think we could see 25 before it, rolls over. And that's probably 2032 or 3, somewhere out there. But if you imagine what the implications of that are, that means interest rates, which track inflation, will likely be, in 1981, the 30-year and the 10-year got up to 15%. In this cycle, I think you could see it up closer to 20%. And how in the heck do you finance debt that can't be financed at 5%? Where's the money going to come from to service that debt at 15 or 20%?
So you think things will be so bad that the politicians and the central bankers will actually have the conviction or the follow through to put people through that kind of pain?
Well, frankly, it's not. No, I don't think that at all. I think they won't be in control. The markets will be in control.
Right.
So in other words, the rates are going there. The Fed could print all the money they want. And what they're going to be doing is pouring gasoline on a forest fire. And so, if they ever tried what Japan's talking about doing here now, if they ever tried that with let's say inflation's moving towards double digits, and they say we can't finance our debt, we need to lower rates, and they cut rates, and to cut rates, they're printing money. You're going to get to that 25% a lot faster, or go higher than that. So they lose the printing press, I think, before the end of this decade, probably 2028 or 9.
Right.
They lose the printing press. Once they lose the printing press, you have to live within your means, and we won't have the means to live. Right? They won't have enough money to service debt. Never mind service the militaries, pay welfare programs, Medicare, Medicaid. It's going to be. That's why I say the system collapses. And again, I'm speaking of the U.S., but this is global. This is, in my opinion, the end of the super cycle that I define as the long cycle between two depressions, the 1930s and what I think will be the mid-2030s, so a 100-year cycle. And it basically is the end of a Ponzi scheme. We've ramped it up every cycle more. It's just, it's a sine wave type thing where it just gets, bigger and bigger each time. The excesses get greater. The response to bring the excesses down get greater, and you get to a point where it just gets out of control, and you no longer really. Our politicians will have zero control over this.
In a world of rising deficits, currency dilution, and market volatility, many U.S. investors are choosing to diversify their retirement accounts with assets like physical gold, silver, and even crypto. This video is sponsored by iTrustCapital, which offers a platform for Americans to hold physical gold and silver, as well as crypto, directly inside a tax-advantaged IRA. Designed around transparent pricing with clear premiums over spot and no hidden storage fees, iTrustCapital offers something that still isn't standard in the precious metals IRA space. If you're a U.S. investor looking to learn more about owning gold, silver, or crypto inside an IRA, use the link in this video description. U.S. residents may be eligible for $100 funding bonus when opening and funding an account with iTrustCapital. Now, let's get back to the pod. Let's articulate the moment the Fed loses control of the printing press, because that's a huge fundamental component to your thesis playing out. When will that happen? How will that happen?
Like I said, I would guess, and I'm just guessing, but if rates are up, if inflation's up in the high single digits, any rational person at that point that knows economics, which means hopefully people on the Federal Reserve Board and economic advisors to the president, whoever the president is in 28, let's say, if interest rates, if inflation is up in the high single digits even, they should recognize that printing more money into an inflationary environment, I mean, they obviously recognize it now. They're going to recognize it even more then. They're going to have to resist the temptation to say, we got to print our way out of this, because that's only going to accelerate the inflation. And then you're really out of control. So I think it's probably latter part of 28. If I were guessing, I could be off by 2 years.
Yeah.
But that we're going to be at that point where you really say we can't print. And the difficulty is we won't have the ability to pay to service all that debt. Because don't forget, whatever the debt is today, if I'm talking about 20 trillion in QE, that QE is going to be accompanied by a lot of new fiscal spending, the new debt. So that if we're talking about 38 or 9 trillion now in just U.S. debt, U.S. government debt, that could be 50 or 55 or 60 by then, and post bust, because of what we did during the bust.
Yeah.
I keep talking about the 330 trillion global debt that's out there. It's a number that at least is considered pretty accurate. That could be 500 trillion by the time we get to the end of the decade, and most of it because of the bust, in reaction to the bust. So, and they're all going to be facing the same inflationary pressures, the same interest rate picture. So, I don't see how the system survives that. And people go, well, how about, all of the things with crypto and, or with gold or all these plans? I go, my only response to that, because my brain can't fathom how I can't put that together and figure out how it does it. My only response is I think the macro just overwhelms all of that. That's a spit in the wind compared to what the problem's going to be, I think.
Yeah. Yeah. When I hear, global debt is well above 300 trillion. And there's, many reports citing that, but you can get to these numbers for gold and silver very easily when you think about just how much liquidity, how much debt has been piled up. Even today, we're having a hard time paying our interest on the debt, which is well above $1 trillion a year at the current rates.
Yep.
How much longer can they keep rates elevated? Like you forecast them coming down here pretty soon. But again, that's the front end of the curve, right? The back
end.
Actually,
I think I disagree with the narrative that's out there, the popular ones.
Okay.
I think all rates, I do believe that in the bust, we'll be looking at a 0.5% or lower on the 30-year. In the bust, we'll be looking at a 0% 10-year. In the bust, we'll be looking at negative short rates. So, and I think that's the beginning of that bull market in bonds, or bear market in rates, I think, is about to begin. So it's gonna happen gradually here in the next 6 months, but then accelerate as the bust becomes the story. Um, so I don't agree with those that think we're going to have long rates going up here. I think they're coming down to there's going to be a shortage of yield. That's the story we'll hear 6 months from now or 8 months from now. Is we have a shortage of yield. What are we going to do? Think about, and people go, well, who's going to buy a 30-year bond at 0.5%? Well, if you're in deflation and there's nothing else out there, you're going to say, at least I'm earning something,
Yeah.
and you're not going to be saying, well, yeah, but inflation's coming. You're going to be worrying about deflation getting worse.
It's hard for people to just even conceptualize.
It's a different world. It's a very different world than what we're in right now.
Yeah. I got to feel good, man. We got to turn this around. So how do we survive the bust? Okay. So metals, everything's going to get hit in the bust. How low do some of these metals go? Gold, silver, copper, how low do they go? And then what's the trajectory after the bust?
I get a lot of questions about what's your target in the bust for silver and gold. And I go, well, we got to see where they go first. I have a target out there of 180 for silver and 6,800 for gold, but I'm not so sure that they aren't going to be raised again. So I have to, we have to really get there to be able to put something on the other side. But what I'd say in general is, I think you probably are looking at maybe 30 or 40% hit to gold from wherever it goes here in the pre-bust, and maybe 60, 70 and more percent or more in silver, because silver is very economically sensitive and certainly a much less liquid thing once it turns the other way. There's a lot of speculation in these numbers right now. I realize long term there's a shortage of silver, and so that's the long term bull story is part of that. But in a bust, when demand's falling through the floor because of a bad economy around the world, silver's going to be more volatile than gold, so it could fall well more than 50%. But let's say it gets to 200, that means it comes back to maybe 70. Maybe it goes back to 50. I don't know, but I can't put a number on because I don't even know where the end game is on the upside yet.
That's fair.
So, but then coming out the other side, you're absolutely right. I think every cycle, and having done this through many cycles, I can say this unequivocally, is that every cycle has new leadership. So, this cycle's been mostly technology and maybe healthcare earlier on, and growth stocks for sure. The next cycle is going to be very much because of the whole story about inflation, but also the story about reindustrialization, reshoring, all the building out of the grid and what the AI is requiring in terms of power. The next story is going to be a huge rebuild of the infrastructure or expansion of the infrastructure. A lot of industrial expansion, and when you're building new plant equipment, well, what do you need? You need commodities. So it's going to be a huge commodity super cycle. And so those are the areas of leadership will be, and we're seeing some of that obviously late the cycle. So it's easier to understand today than maybe 3 or 4 years ago when everything was consumer and tech. But it's going to be industrial stocks and commodity stocks that I think will be the leadership. And when I say commodity, and I've been a bear on oil and energy for the last few years. But when I say commodities, energy will be right at the top of that list, because I think oil could get down to 30 in the bust and go to 500 in the next cycle. So if you go from 30 to 500, you can imagine what that does for oil stocks and for oil service stocks. And there's not going to be enough energy out there to satisfy what I think is going to go on. What you're doing is you're we spent decade after decade for really since the late '80s, probably, or mid '80s, rationalizing down our capacity in commodities. So less mines were developed, less steel mills were built. China's probably the exception; they expanded a lot during that time, but the rest of the world really, it was we have to make money. We can't make money with this excess capacity out here. We're going to shut down capacity. We're not going to build new greenfield mills or plants, and we'll satisfy just-in-time inventory, et cetera. Then all of a sudden, you goose up the economy through this 20 trillion in dollars coming out of the U.S. and what maybe in the aggregate is 50 trillion coming out of the world. I don't know, but you goose up the demand because demand will follow with a lag. It's not going to happen 6 months after you do it, but within a year or 2 years, demand's roaring hot, and it takes you a decade or more to build a new plant or to develop a new mine. You can't. You've ramped up demand, but you can't match that by ramping up supply. It takes too long. There's a long lag to that. So that means you're going to have massive demand and a limited supply, and the only thing that can give in that environment is price. And that's why you can get gold going from 5,000 to 25,000 or whatever it's going to be, probably more than that, and silver going from $50 to maybe $1,000 or something. So and copper going from, I think copper in the bust because it's so economically sensitive could be $1 or $2. Now I'm calling for $8 copper pre-bust. That's my current target. So it could fall to $2 or $3 or less. Post-bust, I don't even pretend to put a number on it, but maybe it's $20 or $25. I mean, we're going to see, obviously, when I talk those numbers, that's inflation, right?
Yeah.
We're going to see commodities go through the roof. Oil obviously is a big part of our economy. If you get $500 oil, you can see why you might have 25% inflation.
No kidding. But there is a demand component, like, in my mind, you either need incredible inflation or an economic boom to sustain $500 oil. Is it going to be 50-50? Like, is the boom going to be starting to come, or is it going to be like 80-90% driven by inflation, those types of prices?
No, the demand is what drives the price. So the demand comes from all that printing.
Okay.
And, obviously there's a money component to a monetary component to it, and then there's the underlying story, which is reshoring and the need for data centers and the need for power, et cetera. All that requires commodities, energy. It requires steel. It requires all the metals, et cetera. So it's the money that stimulates, but it's also the what we're doing as an economy. So it's funny how it fits hand in glove that we're at this point in the super cycle where we are in need of reshoring because of what happened recently in terms of supply chains, et cetera. And because we spent 3 decades raping the U.S. of its industrial capacity. So we're now just reversing that course. And when you print that much money, that's going to speed up the process of how we reshore, I think, because they wouldn't have the resources if it weren't for all that money coming in too. So they kind of go hand in glove, and between the two, it basically ramps up your demand, and then that in turn translates into inflation through price increases, et cetera.
Yeah. So, does the U.S. rise from the ashes after this, collapse, which you've described, right? We get 25% interest rates with that level of debt, and the system basically just collapses at some point in the mid-30s or early 30s. What does that look like? How does the U.S. come out the other side of this?
Yeah, I think the other side is a long story. I mean, we're used to having recessions that last a year or two, and the bad ones, it's 2 years or 2.5 years, and it seems forever. This is something where this is Great Depression on steroids. I think I don't know what comes out the other side. Is it a great reset where we can start all over and do it better? Or is the world blowing up in this? Because obviously there's geopolitical risk too. What I will say not the big picture of all countries and what's going on, but just kind of, it does seem to me that if you have a situation where you might have as much as 50% unemployment, and of course you got other factors like AI, et cetera. But let's say we have 50% unemployment because of the economy and whatever else is going on. You're not going to have a government that can fund welfare. You're not going to have a government that can fund your Social Security. Is either going to be totally gone or a small fraction of it is available. Medicare, same thing. Medicaid probably is not there. They don't have the money, and they're not able to sell debt because who's going to buy your debt if you can't even service what you have, right? You're going to default it on debt long before that. So basically, we've played this game for probably 50 years at least, where we've because of the ability to borrow money, both individually and government-wise, we've pretended that our standard of living continued to grow or held its own, when it really wouldn't have been the case if we didn't expand government to the extent we've done it, right? So we look like we're a lucrative society, and that everybody has 2 or 3 TVs and a car, and we say even the people that are on the bottom end of this are living better than anywhere else in the world. But if it weren't for the printing press and the bonds, or the debt, it would have been clear that our standard of living was dropping decades ago. So it's all going to come all at once in a much more stark fashion when things collapse. So it's kind of a catch up for 50 years of mismanagement, basically.
Yeah. Sounds like revolution, David.
Well, certainly that's, people go, what do you do with that scenario? What do you tell people to do? And I go, the only thing I can tell you is that you've got basically a decade at most, probably, to get your financial house in order. And if you can get your financial house in order, the better you do with that, the more control you'll have over the bad times. And then when things really get bad, it's, I don't want to talk about having guns and all that, but
basics,
it could be anarchy.
Access to clean water.
I mean, we see it in other parts of the world. We just never saw it here. And, it's, I think you really have to know your history and recognize that, we've lived this great experiment here for, hundreds of years, but it's maybe coming to an end. Yeah,
well, we'll see. But the structural deficits every year gets worse, and you never know what these financial wizards can come up with. A lot of people thought the bust would have come 5 years ago, 10 years ago. So they do seem to have this ability to kick it down the road. But I share in your consensus that it is a Ponzi scheme, and ultimately, confidence will be lost. So it is.
Yeah, that's why I do say that I really do believe we can kick it down the road one more time because we can print money. The problem is, when you lose the printing presses, when you have hyperinflation, they just don't have an answer for that. If you need to grow things, if you need that money to expand the economy, and doing that increases the inflation, you basically, you're a rat on a wheel trying to, the faster you go, the harder it is to catch up, right? So the real analogy is gasoline in a forest fire. It's basically you're pumping gas out of a hose, and it provides you money right now, but we've seen the Weimar, the wheel.
Yeah, I was going to reference that. Germany came out the other side of that, and there's some great books on that. Dying of Money is one. The Economics of Inflation. obviously being the world reserve currency, there's a big difference there. But is it possible, to just through this inflation, go through this period of a year, 2 years that's, horrific, where a lot of people will get wiped out, but the debt will also get wiped out, and we come out the other side, like the way Germany did. I mean, it took them some time, but they came out strong.
For sure, this is a forecast, or my
Of course.
my best guess of what is coming because of the combination of factors that lead to that hyperinflation.
Yeah.
The problem we have is just the massive debt in the system, not just here, but around the world. Again, I am not worried, certainly not for the U.S. and probably not for most of the world, in the bust of a sovereign crisis. The debt crisis we have in the bust is a private debt crisis, a debt liquidation crisis, as what we saw in 2008-9. As banks fail, as companies fail, as people go bankrupt, you're going to have an involuntary debt liquidation cycle.
Mm-hmm.
But I'm not worried that Treasury bonds are at risk or Treasury bills are at risk, and I'm probably not worried that Canadian bonds are at risk, government bonds, or because they all have the printing press. If we didn't have a printing press, it'd be a different story, maybe. But so this time around is not a sovereign debt crisis. Next time around is a sovereign debt crisis, which is the much bigger part of the debt equation, right? We have massive sovereign debt.
Mm-hmm.
If they can't service their debt because of inflation, if they can't come up with enough to fully service it, all of a sudden you start getting into a default cycle, right? So that's what really comes. Now, I've heard people say, well, you can just forgive debt. The problem is
debt jubilee.
People on the other side of it, right? I mean, if you forgive debt, what do you do to the guy that depended on that debt? Had income coming off that debt. You're going to have somebody's going to get hurt very badly, and I'm not talking small numbers of very badly. So there's not an easy solution. Could I be wrong? And somehow we don't get the hype. We don't get inflation going nearly as high, or they come up. They're able to use gold to pay down debt, or somehow it softens the whole scenario a lot, and we just keep going on with this. But I remind you that if you go back to, let's say, 1940, coming out of the Great Depression, and each cycle we had, yes, we had inflation back then, but inflation was maybe 5%, and they had to ratchet it down because they were getting overheated, and they didn't have to go too far, and so it came down, and we didn't have a real deep cycle. Then the next time a little worse, and the next time a little worse. What we've seen, again, it's like that sine wave. It's each cycle, the exit have gotten so much bigger. How many more times can we do that? The swings are just getting too big to manage. And that's where I think we're at.
Do you have any final last words? I know your core framework is all about, psychology and sentiment. Is there, an indicator that you want to sort of leave our audience with to just keep an eye on as we move forward here and get closer to what you see?
Yeah, my feet are in two places. One is macro. Like I said, I've done it for a long time. I feel very comfortable with my ability to forecast macro. And then the sentiment is the other piece. And I use technical analysis stuff too to help me. But I would say I don't have any particular indicator I'm watching. It's really my sense is that once you see institutions all in, retail's stayed very bullish. Even last April, they remarkably didn't get caught in that. The institutions did, but they didn't. Once you see, and the institutions now are getting on board and starting to realize they were skeptical from October 22 all the way up till very recently. They kept saying, they had one foot out the door and saying, this thing's going to roll over, this thing's going to roll over. It's just going a little farther and it's going to roll over. They're now beginning to realize, hey, this is a bull market that has more legs. In fact, they're going to start passing me and saying, oh, this can go for, in fact, you're hearing it from the Ardenian folks, this thing could run for 3 or 4 years. And I'm saying this year is the end of it, probably. So as you see the institutions becoming the cheerleaders for a bull market and telling you you're wrong to be bearish here, that's the switchover that will begin to tell you you're getting closer. And, and as you see the market steepen, because I think this leg, which I believe I wasn't expecting it, but when we saw last April, that created a new leg. So I thought we were going to go straight to the top, but because of that 20% sell off in the S&P or 19, whatever it was, that created another leg. We had one, coming out of 22, we had another leg in October 23, and I think we may have had another one in October 24, and then April was another leg. I think we are now despite consolidating now, we're still in that same leg that I think will steepen, so it'll be steeper than the leg into April. Once you see that go vertical, you'll know time-wise you're getting very close. I may find that my numbers aren't high enough. I mean, when you go vertical, well, silver's a good example.
Yeah.
Once you go vertical, take your pick. What number is it? Is it 110? Is it 122? Is it 180?
Yeah.
Is it 250? There's a guy out there, Oliver, who is saying we could see $300 or $400 silver this summer. I mean, he's a good guy, and I'm not questioning him. I can't get there right now, but he could be right.
Yeah, he's a great guy. I had him on a few weeks ago. David, as always, such a pleasure having you on. Thank you for your time, health and happiness. Best of luck.
Thank you, Alex.